Okay, this is another consolidation problem of the subsidiary that is 100% owned by the parent, but now we are several years after the date of the acquisition. So this does make it a little bit more complex when we talk about our acquisition accounting premium assets. So we have assumed that the parent company acquired the subsidiary company January 1st, 2019. The purchase price was $1,924,000 in excess of the book value. So that is the $1,924,000 is what I call the acquisition accounting premium. So it's what we paid extra for. So we have property, plant, and equipment that had the original value of $156,000. We are depreciating it over 8 years. We have a customer list of 416,000, and we are depreciating that over 8 years. We have a royalty agreement of 312,000. We're going to amortize that over 12 years. A database of 390,000, amortize that over 5 years, and then the goodwill is not amortized. So again, they're telling us that those will be amortized. Again, goodwill is not. They give us the financial statements at the end of 2022. So we purchased it in 2019, so we would have 2019, 2020, and 2021. So 3 years we would have amortized and depreciated these assets because we're always at our beginning of the year. So we're at the beginning of 2022 when we are preparing our entries. So the first thing it asks is compute the equity investment balance. I always, I guess I normally start with, I guess I kind of skip that one. So I jump into B. So B, we have our reconciling out our equity income. So if we look at the subs income statement, their net income is $409,500. If we look at the parent, they have $234,000 as their equity income. So remember, that represents their 100% share of the subsidiary's net income. So then you want to know, well, what made that difference? What's the change between those? So if we go back through our depreciation, so again, the property, plant, and equipment, $156,000. Divide that by the 8 years, that gives us the $19,500. Same thing for the amortization. If I take the $416,000 of the customer list and I divide that by 8 years, I get the $52,000. Then the royalty agreement, $312,000, divide that by 12 years, I get $26,000. And then the database of 390,000 divided by 5, I get 78,000. So when you subtract all of those out, you are reconciling the subs net income to the equity income that the parent shows on their books, and we've double checked it and we're good. Then C says, okay, now reconcile out the equity investment. So show what's in the $3,250,000. So like I said on the last problem, I like to do those in terms of the journal entries that we have to make for consolidation. So our E entry represents the book value. So the common stock of the sub, $195,000. The paid in capital of the sub, $663,000. And then again, remember, beginning of the year retained earnings, which is over here on our statement of retained earnings, is $816,400. So we add those up, and that represents the book value of the sub, or the E entry. Then our A entry, this is where it gets a little trickier than when it was just a year after the acquisition. Now we're 3 years from the beginning of this year, the beginning of 2022, we are 3 years after the acquisition. So that means we've depreciated this property, plant, and equipment for 3 years, customer list for 3 years, royalty for 3 years, database for 3 years. So we want to take that original amount and subtract what we've depreciated already. So then that's what I have there in the parentheses, and then that gives us our beginning of the year value after 3 years after the acquisition, and our beginning of the year value in 2022. And that is what's going to be in our A entry. And then finally, our equity income, that's the same as it was in our in our problems, even just 1 year later, we are going to eliminate our equity income of the $234,000, eliminate the dividends that were paid from the sub to the parent, which again is all of those, and then that's going to get hung up in our equity investment. So then if we add those three together, we see that we tie out to the $3,250,000. Then D says, okay, now prepare your journal entries, or your consolidating entries. So then we've got our E entry. Okay, let me go down a little bit. Okay, so we've got our E entry where we're debiting common stock, again, taking the sub's common stock off the books, debit paid in capital, taking their paid in capital off the books, debit the beginning of the year retained earnings over here on the statement of retained earnings, and then that entire credit goes to the equity investment. We are bringing the property, plant, and equipment, the customer list, the royalty, and the database all up to their beginning of the year values. So what we mapped out up there are all of our debits, and then that credit goes to the equity investment. We are eliminating the equity income of $234,000. We are eliminating the dividends at the $55,900. So again, we're taking that off of the books and taking these off of the books. And then that net difference goes to our equity investment. And then this final D entry records the depreciation for all of these acquisition accounting premium assets for the year of 2022. So remember, this was at the beginning of the year. This is our 2022 entry. So we debit operating expense for $175,500, and then we credit each one of the accounts. Then our final step is to prepare the consolidated worksheet, which is down here below. And again, I'd like you to look at it just big picture wise, look at the format. We've got the two columns for the parents. In our consolidated column, we're going to have formulas that add those across and then adjust for any of these consolidating entries. And then notice how all of the consolidating journal entries are color coded. So when you are preparing this for your Excel project, I expect it to look like this. So then we'll go through again journal entry by journal entry, but here's our E entries. So eliminating that common stock, that paid in capital, beginning of the year retained earnings, offset goes to equity investment. Set up all of our acquisition accounting premium assets by debiting those. The offset goes to the equity investment. Eliminate our equity income, our subs dividends paid, and that offset goes to the equity investment. And then notice that it zeroed that out. And then we record our depreciation and amortization for the year, and then reduce those accounts by 1 year of amortization or depreciation. And then once you do all your journal entries, always double check that your debits equal your credits, and then go through our consolidating checklist. Our equity income should be 0. Our net income should equal the parents. Our entire statement of retained earnings should equal the parent's statement of retained earnings. Our equity investment should be 0. And then all of our equity accounts should equal the parents. And if those double checks all work, then you know that you've done your consolidation correctly.